Welcome back. You're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. A third quarter growth in GDP was 0.7% quarter on quarter. This is according to figures that were released by Stats SA on Tuesday. Following that announcement, experts were quick to point out that we only narrowly missed going into a technical recession and that some sectors, such as agriculture, already entered a recession following 2 quarters of negative growth. But in studio with me to help me look at the outlook for the South African economy are Colen Garrow, economist at Lefika Securities, Annabel Bishop, chief economist at Investec, and Lesiba Mothata, economist at Investment Solutions. Gentlemen, lady, thank you so much for joining me this afternoon. Lots to talk about. Annabel, let me start with you because from the introduction, it looked just very negative. Are there any positive spots here?
There are some positives, but perhaps just before we proceed, maybe just to, on the quarter, we actually only grew by 0.16%. So we didn't grow by 0.7. I think that's really why we've got this very negative view towards the figure, you know, that it was close to stalling, that, you know, we just narrowly avoided a recession. Look, I think we certainly saw some positivity coming through from the retail side and the financial sector side in comparison to the other sectors that did so poorly. But even growth rates in those areas are not particularly strong. And I think it really is reflective of the weakness that we're actually experiencing across the macro economy.
Weakness that we're seeing there, Colin, I mean, Annabel said there definitely are some bright spots, but there are definite pressure points here.
Oh, without a doubt. You know, just looking from the top to the bottom of the GDP release, the first one is agriculture. In recession, a couple of consecutive quarters of contraction. And it doesn't matter which area of the GDP numbers you look at, whether it's primary, secondary, tertiary sectors, services, or the supply side. We've seen pockets of weakness throughout. It's weakness generally. You know, where the positive news is going to come from, I'm starting to wonder, you know, because we haven't seen the impact yet fully of things like economic, you know, the drought, the impact of that. Events in Europe, the impact that has to have on our manufacturing figures. And you know, by the way, that was one of the positive contributors, in fact the strongest contributor to Q3 GDP numbers. So you know, one questions the sustainability of improvements like that. So Q4, difficult, I think.
Let's maybe throw forward to Q4, Lesiba. We've had a lot of analysts that have been saying with South Africa, we just narrowly missed that recession. Are they right by saying that? Are things just looking as though we could possibly be entering a recession? And if we do, what are the implications from an investor sentiment?
Yeah, you know, recession is it's an interesting word.
Yeah.
Russia, minus 9% contraction in the first 6 months of this year. That is a recession. Brazil, minus 6% contraction in the first 6 months of this year. That is a recession. I don't think South Africa is there.
Okay.
Even in that Q1 number, Q2 number of minus 1.3%, Lesiba, the governor of the SARB, had said that there's about 2.2% reweighting or readjustment of GDP that needs to happen because there's a mismatch between the demand side calculation of GDP and that from the supply side. So if you just take that, it suggests we're in very lackluster growth situation, but not quite a recession, as I had explained with the other countries in BRICS that are in dire situations.
Annabel, you're giving me a look like you want to jump in here in terms of what you agree.
I just had some thought on the fourth quarter, and really that if we had a look at the third quarter statistics, when, as we said, our GDP growth was very weak, you know, just essentially 0.2% on the quarter, we actually had a business confidence reading that was very depressed, and we had a leading indicator reading which had, you know, shown strong downward trend, and now those indicators are coming out for the fourth quarter, the business confidence reading and the leading indicator, and they're showing even further deterioration. So it just seems as though the fourth quarter might not make a strong rebound. It could also be quite weak, and I think that does imperil the forecasts that we are seeing for the year as a whole of 1.5%, 1.4. I mean, I think we're probably going to come out maybe at 1.3 instead.
Colin, you mentioned quite a number of issues there, drought being one of them, that have definitely contributed to where we are in terms of the depressiveness or the negative sentiment. What other data points or factors should we be considering, especially global factors that may be playing into, may have a significant impact on South Africa?
Well, I think the primary driver now must be the US economy. and that worries me in itself because the growth is not diversified enough throughout the global economy. So if something happens in the States and it does trip and fall, the impact is immediate on South Africa again. And if you look at the BRICS economies, you rightly point out Russia, slow down, Brazil, slow down, recession in both, at China, at South Africa. There just seem to be so limited opportunities. In fact, I would say the risks are still biased towards the downside on our GDP. The global background isn't, I believe, strong enough. It's not diversified enough, the improvement that we're seeing. The Eurozone growth is coming through, but one has to now start questioning events, recent events, political events, the impact that's going to have on PMI figures and the lead it's got on manufacturing figures. And just if I could just touch on what Annabel mentioned on the lead indicator. Our figures aren't good. If you look at the annualized growth in the Reserve Bank's leading indicator number, we've been contracting for almost 2 years. 23 consecutive quarters of contraction, monthly contraction. So that's worrying in itself. It's also worrying that of late, over the past few months, that contraction has now started accelerating. So it's moving the wrong way.
And at an even faster pace.
Exactly that, yeah. And if we look at the pocket of hope that we've had in our GDP stats in Q3, manufacturing, if you go into the PMI figures and you look at the leading indicator in that number, it's not positive yet. So a lot can still happen to destabilize our manufacturing, yes, and maybe not therefore be the strong, sustainable contributor to Q4.
Lesiba, I just want to come to you because what levers do you think central banks have? Colen was talking about the examples that you gave within the BRICS countries. In terms of monetary policy, last week, we saw an interest rate hike. Maybe thought it would be good for our local currency. Hasn't really proven to. So what levers can we push?
Yeah, so monetary policy when it comes to GDP and the structural outcomes in the economy is very limited. They can do very little to change that outlook. Because where they sit now is we're in a situation where inflation expectations are anchored at the upper end of the inflation target range, which is a concern. And of particular concern also is that we're beginning to see outflows of capital out of bonds and out of equities, the largest we've seen this year in Q3. Now that has left the SARB very fidgety, unsettled, fretful. And in it, they're likely to hike more interest rates. So they can't help much more in terms of just supporting growth, supporting lower interest rates to get it going. I actually think they're going to hike, and they should be hiking because inflation is the primary focus.
Annabel, do you think we might see the US Fed hiking come the 16th of December?
Our house view is for a hike, yes, so we do anticipate that they will hike. But I think I might just disagree with Lesiba on his comment that he's just made now.
I always love a disagreement.
I don't think the Reserve Bank should continue to hike. Indeed, they've actually said at their last MPC meeting that every 1% hike they deliver cuts economic growth by 0.4%. And that's one of the reasons why we're having an economic growth rate of closer to 1% this year, then closer to 2%. But I think on the portfolio capital outflows, if you have a look at the direction, certainly since the 23rd of July when we got our interest rate hike in that month this year, we've seen a very strong outflow of sales, as Lesiba says, net of purchases for equities, and that's been close to the 30 billion mark. And we've also seen strong sales of bonds as well. Now, very interestingly, as the economic outlook deteriorates, so the outlook for equities deteriorate, and foreigners have actually been voting with their feet for this outlook for South Africa. So my view is that further interest rate hikes will continue to harm economic growth, and furthermore that inflation expectations, quite correctly as Lesiba said, are at the upper end, but that's mainly because of the exogenous factors that are driving them there, whether it's state administered prices such as electricity and water tariffs, whether it's your drought that we're experiencing, and a number of other factors that you can't really influence with interest rates. But I also think as well that we may be surprised next year. Inflation may come out closer to 5.5% or even below if the oil price actually comes off. And there is quite a strong possibility we could enter 2016 on a meaningfully lower oil price, and that would remove that base effect that's been inflating the 2016 CPI inflation outlook. So we may not necessarily be in for a steep upward rate trajectory next year, even, you know, seeing at least 75 basis points.
Where do you stand in all of this, Colen? Lesiba camp, Annabel camp?
Ditto, absolutely ditto. If I could just add a very strong view, I believe our monetary policy is wrong. Not that the Reserve Bank is doing a bad job, it's doing exactly what it's mandated to do. The change has got to come, I believe, to the inflation target, and it's got to come from National Treasury. We have an exogenous factor right now in the drought. And we're going to be responding to that food inflation, which is rising. We saw the PPI numbers yesterday. Ironically, by putting interest rates up. So we're penalising the economy, you know, more than once. I believe we've got to acknowledge this factor. The Reserve Bank was maybe step aside in its tightening bias. My feeling is the move higher in interest rates is not data dependent. Certainly it's not. Economic growth is not there. Inflation is only going to go to the target band maybe in Q1. We need to be looking at something else. The economy is put in a straitjacket, I think, because the tightness of this inflation target is not dealing with this exogenous factor in the drought correctly, and we're going to be putting our interest rates up more and more. But I think monetary policy action has become not data dependent, but rand dependent. We're speaking about the capital flows, outflows, the danger to the balance of payments. That is your argument for higher interest rates, nothing else. And to my mind, it's going to penalise the economy, push us quicker to recession than what we think.
I've got 30 seconds. Lesiba, I'm going to give you an opportunity to give your comeback here.
Yeah, so it just shows that there was a 4-3 vote in the MPC, and I think you'll find it here. Yep. I'm firmly in the camp that you need to hike rates to stimulate savings, which will fund investments.
Where's growth going to come from?
Growth should be coming from other sources. So you look at countries like China, they think about it, and they're trying to source different ways of getting the growth. So if you continue on the status quo, which is we're on, we support growth by lower interest rates, which hasn't helped. There's been low for a very long time, negative real rates for a while, hasn't helped the GDP outcome. So we can't do the same thing over and over again, expect different results. So I'm firmly on the camp that the SARB should actually have hike rates much quicker, even much higher.
Well, I think maybe the SARB was, what is that, insanity, doing the same thing over and over again, expecting a different result. Maybe we've broken out of that insanity. This is certainly, this is what I call a debate. Thank you so much. That was Colen Garrow, economist at Lefika Securities, Annabel Bishop, chief economist at Investec, and Lesiba Mothata, economist at Investment Solutions. Thank you so much for joining us, but remember that you can go and get yourself a copy of that magazine that is available at your nearest store, but it's also available online. And until next time, have a fantastic weekend. Goodbye from us.